So, you know, by way of context, I just wanted to say that, let me just grab my notes so I can make sure I say what I wanted to say. You know, Mason and I have come to this from two sort of different perspectives, right? At BlackRock and Barclays Global Investors, we were a shareholder in pretty much, they are a shareholder in pretty much every company around the globe, every major public company. And so I would see these public situations and all the other things we've been talking about sort of just constantly, a constant steady stream on a day-by-day basis. Mason, on the other hand, sort of had and continues to have very sort of deep dive on particular companies and many individualized situations, and really has seen this from the side of being in the boardroom and from the side of trying to get into the boardroom and engaging with these companies. And so between us, I think we bring a slightly different perspective. And I think Mason will talk a little bit as we go through this about why we've both kind of gotten to the same view from a distance, that while tonight's presentation might be hopefully exciting and interesting from a substantive perspective, because these are situations which you might have read about or heard about, and there's a lot of press and other sort of publicity surrounding them, probably the best way of achieving results is not through a PR campaign that winds up beating up on anybody. That doesn't tend to be the long-term value creator that some of the other components we've talked about. But nonetheless, we think certainly very interesting, sometimes really exciting, sometimes adrenaline rushing, and so and certainly things that you would have read about and seen along the way. So just to sort of start us out with a little bit of context, remind us where we've been and where we're wrapping up today. 10 years ago, there really weren't any proxy contests. I mean, 20 years ago, there were like corporate raiders or in the 80s and whatever. But proxy contests, like where a dissident would put up a board slate for someone to vote and try to vote out some of the management directors and put in dissident directors, this wasn't really happening. There weren't really activists, particularly. There weren't very many shareholder proposals on corporate ballots. The SEC and the exchanges had rules that classified votes as routine matters. And routine matters that was an important distinction because at the time, something called the broker non-vote was allowed to be cast. So if a brokerage house, let's just use Schwab as an example. Let's say Schwab's clients held millions and millions of shares in different companies, but individually maybe somebody owned 10 here and 100 there and 1,000 there. Well, if they didn't cast their votes, the brokerage house could send in a vote for the non-vote, right? So they could fill in the gap there. And the brokerage houses pretty much just went with management recommendation as a policy. I mean, that's just what they did. They didn't try to think about these issues. They just sent in a vote that said for management. Well, and they were allowed to do that for any routine proposals. And at the time, 10 years ago, routine was a director election. So the very most important thing I would argue to you that shareholders have to vote on, the one single most important thing, is who their representatives are on the board and whether those folks are doing a good job. That was a routine item. So my point is that 10 years ago, the landscape looked dramatically different. And if you fast forward to the next slide and to today, in the last 12 months alone, according to Shark Repellent, there were 48 proxy contests that went to a vote in the US and Europe, about half in the US, half in Europe. And there are approximately, according to some of the best empirical research out there, about 300 sort of activist situations of one sort or another. And by that I mean, company gets letter from activists. Activist files 13D that they're buying a certain number of shares in the company. Some activist activity. This is dramatically different in 10 years. This season, first time ever, Larry Fink, the CEO of my former firm, BlackRock, sent a letter to 600 CEOs saying, hey, we want to engage with you prior to proxy season. There's never been a big asset management firm that has stepped out in a public way and said, hey, we're going to come to you in that very public way. When we started Glass Lewis in 2003, there was just ISS. There really were not many advisory firms, and now there's Governance Metrics, there's Glass Lewis, there's ISS, there's all these different firms that provide ratings, analysis, information around corporate governance. And the proxy teams, every one of the big institutions has taken up their game in terms of how they've staffed this function, how many people are staffing it, what it really means to perform the function. It's just dramatically different. And I think the one last point I wanted to highlight was the bottom bullet on there, which is if you look at activist slates today, take a look at the Yahoo slate. Just go out and Google it and see the names of the people who are on there and what their bios read. There are people who are like traditional corporate executives agreeing to serve on dissident slates. That is even 3 years ago unheard of. Corporate executives, it was like you're in one camp or you're the other, and you're in the other. But to actually agree to serve on a dissident slate was like heresy, as recently as 3 years ago. Why am I telling you all this? We're going to get back to it at the end. I'll talk about where things are going. But we told you that we think activism is happening in a new way, in an interesting way. And we went so far as to say that we think it's sort of reshaped the investment landscape, and it will going forward. I'll talk to you about going forward at the end, but I wanted to set the context again to remind you how much it's already reshaped the landscape. So Mason's going to take it from here for a little bit.
Sure. So I'm going to try to take it from the macro into a little bit more of the micro and talk about what it's like being an activist who's looking to take on a company publicly. And this, if you guys weren't here last week or the week before, I talked about our firm, which has really evolved our approach to be much, much more behind the scenes because we believe it's more effective. We didn't figure that out off the bat, though. We had some trial and error along the way. And I'm going to give you guys some specific case studies of things we did, one of which was successful, one of which was a disaster, later today. But the point I want to make to start off with is this is really hard. And it's hard for legal reasons and practical reasons. There are a few rules. I've put up here the two that I remember most vividly. Section 13, which relates to forming of groups. If you form a group, which means you intend to work together and vote together, you have to disclose that you're a group, and also if that group exceeds the level at which a company has a poison pill, that group will trigger the poison pill, which is disastrous and wipes out your investment. So people tend to be exceedingly cautious with this, and oftentimes are very afraid of talking to any other shareholders. And you have these highly awkward situations where you're kind of shooting in the dark and almost sending smoke signals with your public messages and hoping people or messages in a bottle, hopefully somebody gets them and somebody's paying attention out there. And so a lot of your communication often tends to be this weird sort of public stuff. You also have weird situations where companies will agree to talk, but everyone disclaims at the beginning, we're not a group, and or some people say, there's a big asset manager out here on the West Coast that had a policy that they would go in listen-only mode. They'd take a call, but they would not say anything. So there's just silence on the other end of the line. You're sort of, hello, anyone there? And that's thawing out. People are getting a little bit more relaxed about, it's the rules are clear. You can follow them. You don't need to be completely isolated. But at the time when we had our experiences in this, that was one big problem, which was nobody wanted to be open or work together. The other one is the Section 14, which relates to the proxy rules. Until you've filed a proxy, you can only talk to or influence 10 investors. So that's something that you need to watch very, very carefully. The funny thing is, the big investors that really matter, if you could just talk to the top 10, you'd win everything, because top 10 shareholders in most of the companies we invest in are well over 50% of the vote. The problem is they don't want to talk to you. The ones that do are the little, people who own 100 shares, and the Johnny-come-latelys are all more than happy to talk to you. So that's another issue. But on top of that, you've got some practical challenges. One is if you want to mount a proxy contest, it's very expensive. It runs in the millions of dollars when you throw in proxy solicitors and mailings, printing costs. You also have the problem of asymmetric information where the company, you're trying to make a case fundamentally that there's a need for change using your analysis of a business from the outside in, and the smarty pants on the other side of the wall that have all the data can always poke holes in your analysis, and so you're fighting a little bit of an uphill battle. And reflecting on this to prepare, I thought these are sort of the lessons that I took away from our activist campaigns. And we did one proxy fight. We did a number of initiatives to derail mergers. One was when the company was on the sell side, and one when it was on the buy side. And these are some of the lessons we learned. One is it's nearly impossible to coordinate with your other shareholders, even when you filed the proxy and everybody's comfortable with the grouping issues. You still have divergent interests, divergent time horizons. In our one proxy fight, which I'll talk about later, we'd feel like we'd won the vote of this 5% shareholder and be really excited, and then a month later they'd be gone. They'd have sold the stock and moved on. And sort of the attention span, the attention deficit disorder that you see in the public markets is really frustrating. And we sort of threw up our hands and said we can't worry about what anyone else is going to do. And the other lesson, which I didn't appreciate at all, was the importance of institutional investors like BlackRock and the ISS and Glass Lewis community, and that's important. I'll delve into that in a little bit. And the other, and this was sort of the entertaining lesson, was that you have a real advantage in terms of the how low you're willing to stoop, I guess, as an investor versus the standards of practice of a typical corporation. Most corporations go into no comment mode with the press when these things happen. So you can completely shape the media message if you're willing to be open and encouraging and have lots of good data. And so what happens is that the Wall Street Journal and New York Times tend to present your side of the story. It also happens to be the right side of the story, so that helps as well. But you have this ability to this guerrilla warfare where you're willing to talk to the media, you're willing to put out press releases, you're willing to write letters that get disclosed, and the corporation tends to hide behind this wall of silence, which means you dominate the story. Really quickly, I'm going to put up a slide we used in the first session to remind you guys that there's lots of different types of shareholders, and I think it's a little bit silly, but most of these people don't know each other across the boundaries. So we tend to know a lot of the other activist hedge funds, and I tend to know a lot of the mutual fund folks who are real stock pickers. Until I met Abe a few years ago, I didn't know anybody in the institutional investor or the indexing world. Same things with story with the pension plans, and this is just another obstacle to overcome if you're running a proxy fight. Is you may have your buddy that you were as your college roommate's best friend and what have you at a few places, but a lot of times you have no network and no ability to reach out. And the reason why that's really important is right here. I just pulled this afternoon. This is a local company, Autodesk shareholder list. This is the front page of Bloomberg representing the top shareholders. And if I go to the next one, I'll show you how many of these fit into the bucket that Abe represented at BlackRock. All those people, right? So that's a couple of 5% shareholders, a couple of 3% shareholders, a couple of 2% shareholders, and this is just on the first page. Probably a third of the shareholder base is in passively managed investment vehicles. Now, the problem with that is if you're someone like me and you've done a lot of work on the business and strategic rationale for your investment and what the company's doing wrong, and you feel passionately about what is the right course of action because you've studied for months and months and months every mistake the company's done, how the competitors are doing, what's going on in the industry, that's an easy conversation to have with the analysts in that sector at Fidelity or at T. Rowe Price, because they're doing the same thing, right? And we can debate facts, we can debate margin trends, we can debate how the quarter's been going, we can debate what's going on with the competitive landscape. You cannot have that conversation with somebody at a passive index fund because by definition they are buying every stock in the market, and their decision making as it relates to proxy is something completely different. It is largely driven by policies that are customized for each shop, and or by the governance ratings firms. And I don't want to tread into Abe's turf too much. He can speak to this, but the point is, you're banging your head against the wall because you've got this sort of business analysis that you believe in so strongly, and it falls on deaf ears because the audience doesn't have the really sort of agnostic about a lot of those issues, right? And so,
well, I wouldn't say agnostic, and I actually think one of the biggest, and you and I have had this conversation offline before, but I think one of the biggest mistakes that happens out there is that, or mistake may be too strong, but the biggest reality is that both on the company side and on the activist investor side, there are real sort of gaps in understanding the big institutions that are indexed, and how do you engage with them, and what is it that what is the conversation that would resonate with them, and how can you present your views to them in a way that would be successful? It's just, as Mason said, it's a little bit of an enigma for the folks in his shoes. It's also a little bit of an enigma for the company, because the company is obviously equally immersed in its own, hopefully, at least equally, if not more so, in its own situations and what's going on there. And they're used to talking to the analyst at Fidelity or T. Rowe who is covering their sector, but they're not used to talking to the global head of corporate governance at BlackRock, and they don't really know how that process works. And so there are some real gaps there that wind up impacting this process meaningfully. But
right. So I'm just going to. This is a framework we laid out last week about walking through the various issues and who really cares about them. This is the stuff that really entertains a lot of people, and frankly, a lot of these letters tend to circulate around. Everyone laughs about them, calling people bad names. And these are letters from Dan Loeb and Robert Chapman, who are the two maestros of this type of activism. We've never done this. We like reading them. They're funny. There's a good example at the bottom of asymmetric warfare, where you can basically take the company's words directly to you in a private conversation and then spew them back out publicly in the 13D language, 13D disclosures. This, I don't think, really works. Certainly doesn't work at companies that are very big. It might work at a very small company that can be easily toppled because the float of the company can be gobbled up by a few shareholders, and the board doesn't know what they're doing. But it probably doesn't work very well there either. So this is the kind of thing that really gives activist shareholders a bad name, I think, in the corporate community, and is something we try to stay away from, because we just think there's a natural truism of human behavior that people will listen to your ideas if they like you, and if they don't like you, they won't. So moving on, I'm going to dive right into one of our public fights. So this is a stock chart for a company called Chiron that was in Emeryville, California. The big drop we see in the late 2004, early 2005 had to do with their, they were one of two providers of flu vaccines in the United States, and it was made in a facility in Liverpool, England, and the FDA shut it down, cutting off half the U.S. flu vaccine supply. You guys may remember this. It was a big news story. The CEO was dragged in front of Congress and what have you. That caused the stock to collapse. Novartis is a Swiss pharmaceutical giant that owned about 40% of the shares of Chiron from a deal that was done in the 1980s. The big issue for Chiron shareholders, although we didn't think it was getting a little bit overplayed, but it was certainly a huge issue, was whether this Liverpool plant would get back online or not. We bought a bunch of stock right after the breakdown because they had some other businesses that we thought were really worth a lot more than the market was paying for them. And what Novartis did in the summer of 2005, I was at my friend's wedding in Ireland, and I got a call that Novartis had launched a hostile bid from within the boardroom for Chiron's shares at $40 a share. This was on the company was within weeks of hearing back from the FDA whether they were going to get the flu vaccine plant back online. And so we felt quite offended because, as it turned out, the FDA did let them back, and we felt that Novartis, being inside the boardroom, had a view that was about to happen, and so launched a hostile bid for the company at not a very big premium. And then, because they owned 40% of the shares, they said, we will only you vote for a deal involving us. We won't vote for anybody else to buy this company, so it's take it or leave it. And this really offended us, right, as shareholders. This behavior of an insider jumping on an opportunity before the shareholders were informed about it, and we got so worked up about this that this was one of our, I think it's maybe have been our first public attacks. We wrote a very scathing letter to the board saying that this process was terrible and this price is way too low. And you can see that the day of the first Novartis bid, the stock shoots back up, but it stays right around in the low to mid 40s. Novartis and the board eventually got to an agreement at 45. We thought that was still way too low. If you look, 45 is about the price that it was before the flu plant went down. So our belief was that you should get a premium on top of what the unaffected pre-flu plant breakdown was. We were really passionate about this. We had all kinds of analysis done. We used the forecasts that were in the proxy. We had a DCF analysis that clearly made our case. It was of real interest to us that most of the market didn't seem to care. The analysts didn't support us. The ARBs didn't support us, and the media didn't really care. And then a funny thing happened, which was Citibank, which was the largest shareholder, out of the blue filed a 13D saying that they supported ValueAct's position. And that was highly unusual for a traditional money manager, let alone one buried inside a large bank, to do that. And only then did the stock trade above the $45 price. And so you can see it meanders and breaks through 45 on the Citibank vote of confidence. The sort of war of words played out in public. It was interesting. This Howard Pean, who's pictured there as the CEO of Chiron, is actually a very good guy, and I still get together with him and have lunch every once in a while. But he was the CEO of Chiron, and he's never said, but I'm pretty sure he wanted to remain independent, but Novartis had jumped on him, and Novartis represented, and his board could tell him what to do. And so he was being told to go out and basically sell the company short, not literally sell the stock short, but go out there and talk about what a bad company he was running and what a bad job he was doing, and therefore everyone should take this $45 stock because, God forbid, they let it stay independent. And it was, and he was forced to go on a roadshow to tell this story, right, about how bad this company was. And this funny thing happened. So they sent us an invitation to participate in the roadshow because we were, I think, the number 2 shareholder, and we put a press release out saying we refuse to meet with your roadshow. This is not, this is a sham. This is we don't think you believe this. This is ridiculous. How can it be in our interest for you to go around and talk about how bad our company is in the middle of a deal process? So, and then every time we'd release a press release, Chiron would release a press release responding to our release, and then we would respond to their release, and they'd respond to our release. And we were thinking, this is not very smart if what they're trying to do is keep our story out of the media. And Howard's never really come clean with it, but I think he was playing a game with me where he would volley it back to me, and I'd volley it back to him because he wanted it to build and build and build until it became a heard on the street story, and it was a Business Week story. And so here's an example of us taking advantage of the fact that we're willing to press release anything, right? I mean, our press releases sometimes have grammar mistakes and punctuation. We're just keeping the flow of information going. And this company was sort of playing ball with us, I think, because his own interests were aligned with ours rather than what his board was telling him to do. And so when he went to ISS, what finally broke Novartis's back, and Novartis came out, the CFO came out from Switzerland to meet with us, and we had an entertaining meeting with him. I got to hear the Swiss pronunciation of the word bullshit, which was funny. But anyway, we got ISS came out, and Chris Young, who was running this is when I got to meet Chris Young, who was at the time building their new product, which was the contentious situations research product. And he came up with this coinage, which was, he called it a bizarro world. if you guys ever watched Seinfeld or Superman comic books, there was Bizarro World where everything was reversed, right? And this roadshow was Bizarro World because you had the CEO coming in and talking about how crappy his company was, and that sort of offended him and rubbed him the wrong way. Just the fact that this, and you could tell in the body language of Howard that this was not something he believed in, I don't think. And so, but he was doing what he had to do, and so ISS came out with a slam dunk 40-page paper just supporting all of our points. And the minute that hit the press, Novartis got on the phone with us and said, "What's it going to take to get this deal done?" And they did something really smart, which is they negotiated with us and Citibank simultaneously. Goldman Sachs was representing them, and because of this grouping, can't talk to each other, are we obeying the law or not kind of thing, we never talked to Citibank, so we didn't know. So Goldman would go to us and say, Citibank's going to cave at 48. Do you want to be, and that's going to tip everything, and this deal's going to get done. And then they went to Citibank and they said, ValueAct's going to cave at 48. Do you want to let the train leave the station? So we both caved at 48, and we got the deal got done. But the lesson I learned from that was just being right, or knowing you're right, or feeling you're right, or having all the facts on your side and all the argument isn't enough, right? It really hinges on the institutional investing community. It hinges on ISS and Glass Lewis coming out in your favor. And I was very naive because I just thought that that the truth will prevail, and the truth doesn't prevail. Politics prevails, and then I also learned how you work with a reporter. The traditional PR advice is don't trust a reporter for a second. Be very careful in what you say. Don't talk to them at all if you can help it. We went the other way. I mean, I was emailing these guys models. I was just dumping anything I could their way, and they really appreciated that because they never get that kind of love. And as a result, we got every story written in our favor. Now, we also were right, like I said before. So maybe the reporters were just smart, but that was a real sort of growing up period for me because I went from sort of naively thinking, I don't want to beat a dead horse, but you know the point. Go ahead.
So compensation. So these issues come up in a variety of contexts. They also come up in the compensation front. The story I just wanted to briefly mention, I can't remember if I brought this up at all in the first discussion, but essentially back in 2006 when I was head of corporate governance at Barclays Global Investors, Pfizer was undergoing this big vote where Hank McKinnell, who was the CEO at the time, was going to retire, and he was getting a reportedly $100 million severance package. And there was that reaction. There was a lot of outrage at the idea that he was going to walk away with $100 million. And so there was a group of folks in the shareholder community, in the union sort of part of the shareholder community, that launched a Vote No campaign against the Compensation Committee. And so we looked at this very carefully and spent actually a fair amount of time trying to understand what happened and how it was that Hank McKinnell was going to walk away with $100 million. And what had happened was pretty straightforward. About 10 years prior to that, or 8 years, I don't have the exact number of years right in my head, but several years prior, the comp committee had approved a change in the comp plan, which they had put to a shareholder vote. So shareholders had ratified this change. But the change essentially allowed for calculating McKinnell's compensation for purposes of his pension payout. It counted his equity grants, which is very unheard of. That's not a common practice. And it was a bad idea, bad decision. And it led to a very overly generous retirement package. Well, again, the comp committee had come up with this, so they deserved a little anger from the part of shareholders for that. But they'd put it to a shareholder vote, and shareholders had overwhelmingly supported it. So, so I thought, well, that's interesting. So let's talk about what happened next. Well, what happened next was the comp committee realized a few years later that they had made a terrible mistake, and they had absolutely done the wrong thing, and the shareholders had voted for the wrong thing, and they reversed that decision, and they got rid of that provision. But it was too late for Hank McKinnell. Hank McKinnell was already under that contractual agreement at that point. And so they couldn't undo the contract with him without making him whole because that was the deal that he had signed up for. But it was clearly not the right thing to have done. And without shareholder approval, without anything else, the comp committee, when they realized what they had done, when they realized what the impact of what they had done, they reversed their decision and they fixed it so it would never be an issue again. Well, fast forward a few years later, there's now this situation. Hank McKinnell's retiring. He's going to walk away with all this money. And there's a vote no campaign against the comp committee. Well, we had a deliberation. We looked through this. We thought about it in a lot of different ways. And we came to the conclusion that, look, the comp committee had done something really bad at the outset. Most of the comp committee had turned over, by the way, by this time. But you know, the newer comp committee, several of which were still on the comp committee, had done the right thing. They realized that they made a bad decision. They corrected it. It had a bad implication, but it wasn't clear to me at that point that it made sense to vote out that comp committee. It was sort of like a disincentive, you know, to doing the right thing. They had done the right thing. They'd figured it out. And from my perspective, they deserved credit for having done it without even, you know, looking for shareholder approval, whatever. So we had a big discussion about this, and ultimately we decided, well, we're going to support the compensation committee. Well, we cast our vote, and somewhat to my, or not somewhat, completely to my surprise, it turns out that we are a shareholder. We manage money for Pfizer's pension plan. So Gretchen Morgensen at the New York Times, who writes, you know, a weekly column on Sundays, usually the headline column on Sundays in the New York Times in the business section, sometimes on the front page of the New York Times, and sometimes more than just on Sundays, but generally a very well-read and very influential column about corporate governance issues, investor issues, and she writes this article saying, won't it be interesting to see what's going to happen in this vote? Because as it turns out, Pfizer is paying like 5 of its top 10 shareholders to manage money for it. So clearly, they have this vote in the bag. Well, I didn't even know Pfizer was a client. I mean, BGI was a huge organization. We managed a lot of money on behalf of a lot of folks. Unless the client had sort of come in and want to understand our corporate governance process, what we were doing on their behalf as a client, I wouldn't have had any reason to know. We didn't have any client-facing people on our proxy committee, our oversight committee. I didn't really engage with the sales folks, again, except for in this context of a client wanting to understand, well, what's your process? Are you doing a good job for us?
Who do you think fed her the story?
What's that?
Because she didn't come up with this on her own, right?
Yeah, somebody, right?
All news is made in this world. It's not discovered. It's all made by people with agendas. But
yeah, and I could tell a lot of stories actually about back in the day at Glass Lewis. Our CEO was quite good at planting interesting stories that wanted to feature in our research. But anyway, I digress. So she writes a story. I call my proxy committee members together and I say, listen, this is how I want you to know. This is how the process we've done. This is the vote we've come to. Anybody have any second guesses here? Any doubts? They want to talk about this more? No. We've done the right thing. You've done a really thorough process. You followed our guidelines. You haven't done anything inappropriate. You stick with our vote. And I was like, okay, but I marked my words. She will write a follow-up story when our votes come out in August, because in August you have to disclose your votes for the entire past 12 months in a filing with the SEC, and then that filing becomes public, and she will get all those filings for all 5 of those investors, and she will write a story about how we voted. Fast forward, to September, and how to find a fund's true colors. And there's an article about what a terrible guy I am. No, it wasn't personally directed at me, but you get the idea, right? I was responsible for doing this, and of course we must be in the pocket of Pfizer, or why would we have gone this way? And similarly, by the way, back in the April time frame, to make it even more intriguing, one of the proxy advisory firms at the time, which doesn't exist anymore, a firm called Proxy Governance, had made an actually very big tactical mistake early on. And Hank McKinnell, at the time, who was the CEO of Pfizer, was the chair of the Business Roundtable that year, I think it was, or the Chamber of Commerce. No, it was the Business Roundtable, I think. And so the Business Roundtable was kind of frustrated. All the companies were frustrated with ISS and Glass Lewis, and they wanted to see another proxy advisory firm succeed. So they became a client of this new proxy research firm, Proxy Governance, and tried to support what they were thinking was going to be a more reasonable, sensible firm. And so she wrote a story as well about how Hank McKinnell had sort of helped fund this firm. Won't it be interesting to see how they recommend, and so forth. So the idea here was just to give you an example, a real-world example of how all this stuff in the press can play out in a very interesting way. Sometimes, absolutely right on, often not right on, and but being in the midst of it can provide quite an interesting daily existence. The other thing around compensation I wanted to highlight here, these two things at the bottom, and going back to, Mason sort of showed the knock on the different parts of the investor community, right? The pension, the public funds, the union funds, the institution, the asset management firms, whatever. Well, the knock on us was that we manage money for all these big institutions. Of course, we must be conflicted. We can't really care that much about corporate governance. We have to be doing this in a way that's not going to piss off our clients, and therefore we're not going to do a very good job. Well, the knock on the if you go back a couple of slides, the knock on the union funds is that they are very agenda driven, and they're going to do things and say things and be public about things that are in their interest to do and say. And so this is going to an example around that. AFSCME every year puts out a report which has been titled "Enablers of Excess" or I don't know, worst failed fiduciaries in the world, and they put forward these articles that would look at our voting record, and in particular they were very focused on compensation, because in the union fund community this compensation is a really big issue. They're worried that these executives are walking away with all this money and it's not fair, and they're not treating employees equivalently and so forth. So they put out this study. Well, this was another sort of big source of frustration for me at the time over the years, was because we didn't vote in favor of shareholder proposals that told the company how they should do compensation. We would vote against a comp committee if we thought the comp committee wasn't doing a good job. So in other words, in a Pfizer case or some other situation, if we thought the compensation committee was not, if you look back at compensation and compensation was here and performance was here over a 1, 3, 5 year period, and peers, they somehow managed to pay their people down here and perform up here, well, that was a company that we thought didn't have a good comp committee. And rather than telling them how to be a good comp committee or what the right compensation plan is, which is not the role of shareholders, in my humble opinion, we would vote out those comp committees. Well, the union funds would put on lots of proposals around compensation, saying things like, this company should only give away equity grants that are premium priced. They should only use indexed options. They should only compensate in this way. They should only do that. They shouldn't have these provisions in their comp plans. Well, we felt very strongly that that was not the role of shareholders. Shareholders should not, they didn't understand the undisclosed business plan of the company. They didn't understand the wealth profile of particular executives. They didn't know what sort of targets the company might be aiming for that they hadn't disclosed publicly. There's a lot of things that you want a comp committee to do that shareholders can't do. And so we didn't want to be in the business of telling the board what to do. We wanted to be in the business of holding boards accountable for not doing what they should do. And we had a very good record, actually, of voting against comp committees, probably better than most institutional investors. But we didn't support these shareholder proposals. Well, they wanted their shareholder proposals to win. And they would write these studies every year. And if you didn't support their shareholder proposals, you would be the world's biggest enabler of excess, the world's biggest failed fiduciary, which I have the distinction of having held many years. So there's a lot of interesting stuff happening out there. And again, you should take that with a grain of salt, right? You're getting the institutional, the asset management perspective on that. I'm sure that other people would have a different perspective on the Pfizer situation. Obviously, they did. I mean, Gretchen Morgenson certainly had a different perspective. But I'm just sharing with you some of the sort of politics that enter into this, and there are, and it's for you to decide and sift through and think about, well, how much do conflicts play into different things? You could argue that the union funds have conflicts because they're trying to get their shareholder proposals passed. You could argue that we have conflicts because we're managing money for Pfizer. The truth is that there's a lot of different, politics at work out there, and you have to navigate and hopefully hold yourself to a high standard, which I thought we always did, but not always successfully from a public perspective, public impression perspective. Okay.
The next one.
Yeah, I'll just quickly get through this one. On the shareholder rights front, really all I wanted to do is just show you some data, and again, demonstrate to you that there are there are issues in this just sort of straight governance issues that are coming up as well that aren't sort of high-profile proxy fights, but these are straight governance issues, and you can see by the voting thresholds that largely there is a trend toward really continuing to sort of put pressure on companies to reform governance processes over the last several years, and that trend is only getting stronger. If anything, it's not. It's at least even in some cases, it's really getting stronger. Okay, so moving on to the next topic. I think this one's you, right, Mason?
Yeah. So
let's skip that, and we'll come back to it if we have time.
So we did one proxy fight in 2006. I will give you some of the background. We invested in a company called Axiom in 2003. Axiom is a marketing services company in Little Rock, Arkansas that manages consumer data, basically. So they're the ones responsible for you getting spam and junk mail and all that stuff. They track you from, they could track you back, maiden names, all your previous addresses. They got all this data, and they basically sell it. The stock, we bought it at 16. It ran up to 23. We thought we were doing great. We decided to ride it out a little longer. It then backed off and went back into the mid-teens. And yo-yoed in that range for a number of years. They were pursuing a strategy we didn't totally agree with. They were going to invest all the cash flow from their marketing services business into an IT outsourcing business and compete head-to-head with HP and IBM and EDS, which we didn't think make a lot of sense. So we were, for the longest time, encouraging them to not do that, return cash to shareholders, invest in what you're good at. It was run by a very imperial CEO named Charles Morgan. He was this larger-than-life character, very charismatic, physically intimidating, big guy, big head. He ran Axiom like his own personal private company, and it was a weird culture. Everyone was a leader. There was no CFO. There was a finance leader and a spirit leader and a strategy leader and it was a strange place, which probably should have turned us off. But as we do typically is if an investment's not working out with us and we've been around for a long time, 3 years in this case, and try to provide constructive ideas, we asked to join the board. And one of my partners went around and interviewed with all the board members, and at the end, you got a letter saying they've decided that it's a conflict of interest to have a shareholder on the board. So no, thank you very much, which we thought made no sense, and it pissed us off so much that we launched into the proxy fight. There was a few sort of amateurish other things we did. We tried to buy the whole company. We ended up in this proxy fight. And here we have the Gretchen Morgenson article. Trust me, she didn't find this story on her own. And the hook for her was that Charles Morgan was funding the Axiom NASCAR team, which was his personal hobby through the company coffers. This is kind of where it gets sort of you're not proud of your behavior when you get into these things, and I'll show this next slide. So this is the tangled web of Axiom. We hired private investigators to go piece all this together, and it's hard to read, but some highlights here is there's a golf club in Cabo San Lucas, Mexico called La Carencia that was purchased by Morgan and some of his friends with help from the entire Axiom legal and accounting and finance team doing due diligence and transaction execution. There were a number of wives of executives on there that had paid roles from the company or various entities controlled by the company. The bottom line is it was a very incestuous situation in Little Rock, Arkansas, with a lot of use of company resources for things that were not related to the company. It was surprisingly easy to piece this together. And this went up on a website that we had, I think it was called changeaxiom.com, which is another tactic in the 21st century proxy fight, which is the use of the web, right? So right now I think there's a Change Yahoo or Vote Yahoo, or there's something like that going on out there. I don't know if they have stuff like this on there, but they've got their case and their bios of their executives. So you can use. This is sort of an example of this asymmetric warfare that you can do when you're in an activist campaign, which is take information and publicize it. And this was the straw that broke the camel's back. When this went up there, they came to the table and wanted to negotiate and end the whole thing. And instead of taking 3 board seats, we got 2. And the whole thing just every day was, is the website down yet? Is the website down yet? It was just like, that was like all the leverage we had in the world was created by this piece of research. And not all companies are like this, though. I mean, most aren't. You're not going to find this degree of commingling of personal and business. But it's the sort of sad ending to the story is today Axiom stock's probably $9 or $10, and Charles Morgan's gone, and the company was sort of burned to the ground in this fight that lasted a couple of years, and then when we were on the board, a few more, there was a failed buyout attempt. There's all sorts of sort of comedy of errors that that I think we should have avoided as investors. I mean, we lost a lot of money for our clients in this, and a lot of our time was spent on this because, as you might imagine, when this stuff's going on, nobody wants to sit and look at boring old, cash flow analyses on other companies. Everybody wanted to be involved on the team that was doing this stuff because this is exciting. And so it was a big productivity drain. It was bruising. I mean, I'm sure they were doing retaliatory efforts of their own, trying to dig up dirt on those of us at the fund. And at the end of the day, it wasn't good for the company. I mean, there were 2 competing visions for the company's future. So if you were employed in the IT outsourcing business, and you had us out there publicly saying that we should fire you guys or sell you guys or get rid of you, how can you pitch business to a client when they can go on the web and find all this information that this service line you're selling may not exist? And not to mention all the distraction that it cost the executives. So we ended up, I think, with a Pyrrhic victory of winning, but winning the battle but losing the war. And Axiom today is a shadow of its former self. So that's why we don't do this anymore. Because the other nuance of this is once you're on the board and you've won 2 seats out of 8 or 10, the other majority of the board doesn't want anything to do with you. They don't want to listen to you. They don't like your ideas. They freeze you out, and it takes you a long, long time to build any sort of collegial relationship, or even anything approaching a fact-based discussion because it's so emotional, and it's been such a war of us versus them that once you're on the inside, you can't get anything done. Want to back up, or do you want to?
No, I'd just say, these situations where you have these interesting web of relationships, they tend to be a lot fewer today than they even were back when Mason was working on this, like 5 years ago, 6 years ago. But I'll tell you, they're not all the way gone. Google Chesapeake and see what's going on in the Chesapeake situation right now.
Right.
And in terms of high-profile corporate governance questions, I probably don't need to mention the Walmart discussion that's happening out there in the world today. So, there are a number of situations going on even today where you see all kinds of behavior or allegations around behavior that's pretty surprising. And there is a temptation, I think, on the part of activists sometimes to aggressively leverage that to make change. But I'll tell you, my experience has also been similar to Mason's experience in this situation. That, the situations where good winds up happening for shareholders often are situations where it's not a big public fight and you don't burn the company down to the ground in the process, but there is some real meaningful engagement and change that happens. That's the bulk of what Mason's firm does. It's what the bulk of a lot of some of the best activists do. And it's certainly the way the big institutions generally operate in terms of how they do their engagement. Now, I'm not saying a proxy fight is always bad or there's never, there's never a time to call the company onto the carpet. And frankly, a lot of activists do put a big spotlight on companies where there really needs to be a spotlight. And so in some ways, they're doing a public service. But I will just back up this notion that you really, in both of our experience, we found that it's not always as effective and it's not always the best long-term strategy for the company to be super aggressive. Look, I just wanted to wrap up with this final slide, which sort of relates back to the first 2 slides. there is a new landscape. Activism has reshaped the landscape, and I would say it is still reshaping the landscape, and we won't know for a few years kind of where this all settles out. But I can tell you activism is happening, and it's here to stay. It's not going anywhere. And the expectations of the investor community are on the rise. The clients of big institutions like BlackRock expect them to do engagement. The companies actually expect them to engage, because companies know that investors might vote against them on things that 10 years ago they never would have voted against them. And if you're a big shareholder in their company, they want to be able to have access to you, and they expect you to talk to them and explain to them what you think about what's going on, so that they know if you're going to vote against them. Like, what do you want? And we're going to see things like shareholders nominating directors directly at companies through proxy access. That may not be the rule today, but it's going to happen. Shareholders are going to behave like owners, and if they don't, they're going to do so at their peril. So I hope this has been an interesting series for you all. There's so much more that we could talk about and unpack in every one of these sessions, and frankly, it probably deserves an even lengthier sort of treatment and series to really get in and dive into sort of intellectual underpinnings of each part of this. But hopefully, we've given you a good sense in the 3-part series, and we're delighted to hang around and answer questions both right now, sort of in the group, and then afterwards, one-on-one, if that's helpful. So thanks.
Thanks a lot for the conference. I just wanted to know, okay, new landscape. What is your opinion about more engagement? So more engagement by the shareholders. So do you think, going to increase the efficiency of the company? And is it, in a sense, going to increase also the investment fund human resources to deal with more complex situations? And so how, on the long term, do you think the situation is going to evolve, both for the efficiency of companies and for the investment teams?
Well, I can say on the institutional investor front, the big institutions, my former team is about 20 people around the globe. It's probably the biggest team out there in the space, but BlackRock is the largest asset manager in the world too. But the other firms are rapidly ramping up and trying to professionalize the people who are involved as well, and getting more and more sophisticated thinkers and folks who can engage thoughtfully with companies and make good decisions. And I think on the company side, they're dedicating more and more resources to engaging. And so, yeah, I do think that there's a lot that will come out of it. I don't want to leave you with the notion, by the way, that all engagement, I think, is good. I don't think all engagement is good. I think there's a lot of good that can come through engagement, and I think there's a lot of value that can be created through activism. But I think shareholders need to understand what their role is, and they need to perform that role. The board needs to understand what its role is, and they need to perform that role, and management needs to perform its role. And once shareholders start doing the board's job, i.e. they start telling them how to do compensation instead of holding them accountable for doing compensation, or when the board starts doing management's job, i.e. they start telling the management that what strategy the company needs to pursue, rather than hiring a management team that's going to drive that forward the way they should, I think you start to see problems. And I think so. Engagement's good if people if the people play their role effectively. And in egregious situations, boards do have to step in. And in egregious situations, shareholders do have to step in. But they should be few and far between, and you shouldn't lose the main framework of governance while you're doing it. There should be some effort to step in, get things back in the right place, get the right people in the right spots, and then step back into your official roles. And I think only with that sort of approach can activism be successful and value be created. But that's my opinion. I don't know. Do you have a different?
Yeah, I think you're clearly seeing a lot more effort by all different types of investors and putting more human resources behind this issue. I have a meeting later this week with a big money management firm that I knew some of the guys on the stock picking side, and they literally didn't even know how a proxy worked. I mean, it's just done by a different department, and they're trying to bring the two together more, and I think that's all good. So there are changes going on in the investment side. Company side, the jury's out. That's what the Rock Center's for, to study issues of do we actually improve companies. I know either we're really, really lucky at ValueAct, or we're adding some kind of value because it's generating returns. So far, I think there's a mixed bag of track records so far. I think the asset class, if you will, of activist investors is still quite new. The quote-unquote hedge fund activists, and people are still trying to figure it out, and there have been a few examples of activists really doing a lot of damage to companies. I think in the long run, though, having an engaged ownership base and that voice represented is going to be really good for companies.
Yeah, I had a question for Abe. So I'm wondering, you talked about each group maintaining their role, and why is it that you believe that weighing in on compensation, or that I guess actively, really engaging with compensation is inappropriate for shareholders, when to my, ignorant mind, it seems like compensation is actually kind of easy to understand. I mean, you mentioned wealth profiles, so maybe that's, so yes, it might be difficult to understand for some executives, but it doesn't seem like a terribly complicated problem, the type of thing that shareholders are kind of eager to engage in. And it seems like negative votes on compensation packages are kind of in the news recently. I think it was Citigroup that had a no vote on their compensation packages. So I was wondering if you could just expound a little bit more on why that is inappropriate for the shareholder role.
Sure. So I think that there's two reasons why compensation is really important from a shareholder perspective, in my view. Reason number one is that shareholders, you give up a lot in the shareholder franchise, right? And you do it, it's okay to give up what you give up, but you got to recognize in the shareholder franchise you give up a lot. Companies are not democracies. I really think that the whole concept of shareholder democracy is a total misnomer. Shareholders, it's not a democracy, and we don't want it to be a democracy. Companies are designed, we expect our companies to be able to change on a dime, to innovate, to come out with the next generation of the iPad tomorrow, to come out with the next version of the iPhone, to be creating new products, new ideas, and to operate very efficiently and effectively. Government, when we created a democracy in the US, we intentionally set up a bureaucracy. The founding fathers, they wanted the Congress to have two different houses and be elected differently, and they wanted the president and the courts to all serve as checks and balances, and they wanted decisions to be made slowly so that the whims of the people at any particular moment wouldn't take the country in one direction, vastly different direction from another. And so democracy is designed to be a little bit messy and chaotic. That's not how we want our companies to operate. So, but one of the things that you give up in the corporate context that you don't give up in the public context, hopefully, or you're not supposed to, is some transparency. You cannot sit in the boardroom. Shareholders are not invited into the boardroom, and they don't get copies of the minutes, and they don't know what was discussed, and they don't know which director was the one who was pounding the table and yelling at the other directors and saying, I'm going to quit this board, and I'm going to file a press release tomorrow if you guys don't cut that crap out. I don't want to be a part of that. You don't know. So compensation is helpful because it provides a window into the boardroom that you don't really otherwise have. It's a window to see, is this a board that is looking out for the interest of investors, or is this a board that's somehow giving away the store to the management team in a way that's not at all consistent with the interest of investors? It's one of the few barometers you have to sort of witness what's happening in the boardroom, from a distance. The second thing I would say, and probably the more important reason why comp is important, is because in theory, compensation is designed to deliver the value that the company is supposed to deliver to shareholders, right? The whole reason you pay these people is to drive value, to build more products, better services that are going to create more value and drive the stock price up. And so you want compensation to do that. I could spend a long time talking to you about it, but really, there are a lot of things, hopefully, happening in a good boardroom that shareholders do not understand. They do not know that the company is about to launch a new, Coke does not want to announce its next sort of step in in the drink front because they don't want Pepsi to know. They want to launch it at the time that they're ready to launch it and the way that they're ready to launch it. And you don't know that the company wants to develop a new subsidiary that's going to do something that's a little bit different than what the company has traditionally done. And you don't. So incentivizing the management team to deliver following 3 things might be really, really important. You just don't know all of that. And so, and I would argue it's okay that you don't know that. That's part of giving up. That's part of what you give up in the shareholder franchise. And you also don't know the wealth profile of executives. I don't care. There's a whole bunch of talk. So this is a perfect example, okay? There's a whole bunch of talk about how golden coffins, right? These executives are retiring with, like, they're still getting paid after they die. Well, okay, that sounds really bad, right? Like why would they get paid after they die? Like, what possibly are they doing for the company now? Look, if you ask me, if the CEO is like richer than rich and does not need a dime now to live or in the future, but the way that that CEO is going to be incentivized is they can defer all their compensation, everything, to their kids and have it transferred in some tax-efficient way, I don't care. What I care about is, did they pay a reasonable amount relative to the performance of the business? If they want to get their compensation in country club memberships, I don't care. If they want to get their compensation in airplanes, I don't care. Now, you could argue that some of those things, well, maybe they create bad perception issues, and that feels bad to the employees. Okay, I agree with that. Those are board questions. That's why you hire a board. And if you don't think the board is getting the job done, you should fire them. They should get fired. They should have their names put on the front page of the Wall Street Journal. It will have an extraordinary disciplining effect on all compensation committees around the world. But the way to do it, from my perspective, is not to tell them how to do compensation. When I got hired for my job, my boss let me do my job. If I was not doing great, he'd tell me, hey, I don't think you're doing a good job on this, or I think you need to change, whatever. But as soon as my boss came down and started doing my job, that would be a clear indication that I shouldn't be doing that job anymore. So I think the same thing is true with boards. Shareholders ought to hire the board, let them do their job. If they don't do it, they should fire them. They're grown-ups. Yeah.
Who was first?
I think you were first, and then.
So I've been involved with a few proxy fights, behind-the-scene things as a PR consultant. And I think it's really interesting what activist investors can accomplish behind the scenes as well as through proxy fights. And sometimes it's almost like an intervention. They can focus management to sell underperforming assets, to get their strategy in line. I've seen firsthand how management teams will really begin to pay attention to their corporate strategy. And it's not due to anything the board ever did. It's usually in these situations, well, of course, these are select situations, due to activist investors. So I have a question and a comment. My comment is I don't entirely agree with your views on compensation, and I would respectfully suggest that boards are not as smart in many instances as they are often getting credit for. And my question is, do you think 20 years from now we'll see a lot more, how can I say, a lot more experience in the board? I mean, maybe there'll be an entire generation of retired VC investors who will become board members and replace the heads of hospitals that now dominate boards like Johnson & Johnson, and we'll get rid of the professional board members and have people who are really decisive and knowledgeable. So I'd be interested in your comments on the future of board membership.
Well, Abe's got a good anecdote about how many boards people used to serve on. I think what you guys tried to cut it off at 6, and
yeah, at Glass Lewis, when we first started, we would say that you shouldn't be able to serve on more than 6, and we were voting against like hundreds of directors who were serving on 8, 10, 12 boards. Today you don't see that, but you saw it a lot just 7 or 8 years ago.
So I think as people concentrate their efforts and get a little bit more experience and the bar gets raised on what's expected of them, I think they will get more sophisticated. Unfortunately, I think the world is still dominated by professional advisors telling the boards what to do rather than boards thinking critically. And your VC comment's a good one. I'm not in the VC industry, but I think there's a expertise that's developed in the investing profession where you know how to own a company, how to incentivize a team, how to think about creating value. And you're right, that's not present in most public company boards because they're not investors. They're heads of nonprofits, they're ex-CEOs, and they're other executives, basically. And so there is a skill gap, and they're just learning. Unfortunately, I think one of the sad things I see happening is the dominance of the strictures that are imposed by the proxy advisory firms translated into, sort of interpreted by comp consultants and lawyers and bankers into recommendations that boards sort of just swallow without a lot of critical thinking. The lack of critical thinking that I've seen is pretty upsetting to me. So I think we got a long way to go, but I think we've gone from sort of total abdication to being spoon-fed by advisors and a sort of rules-based structure, I think, hopefully towards critical thinking, but it's going to take some time.
And I just say I don't disagree with you. I think there are lots of boards that are not doing a great job, and they could use to change the way they operate. And I think I like Mason's optimistic sort of view about the direction that we're headed. I still don't think that means you should, change the whole corporate governance process. I think it means you should fire boards that aren't doing a good job and get boards that are. But that's my 2 cents.
With the low rates of returns that many funds are getting in the market now, do you see that is there a surge of money from public pension funds and whatever into funds like yours? That's one question. Then a second quick question is, do you think proxy, if now we have private ordering of proxy access, would it make your job easier if a company had proxy access, even if you're working behind the scenes, because that's kind of the hammer threat?
Yeah, on the, remind me of the first question again?
Influx of money.
Influx of money, yeah.
Like
we've seen an influx. I think it's very return track record specific. The sort of activist funds had a heyday in the 05, 07 bull market, largely driven by M&A because a lot of the activities that targets they were going after got sold or got bought out. And then a lot of them crashed in 08 and 09, some pretty spectacularly, discredited the asset class a little bit. And 10, 11, 12, you're starting to see them climb out of the hole. There has been more interest. You've seen interesting things happen. There's been spin-offs out of some of the big name activists. In other words, the junior partners have left to start their own funds. So you're seeing proliferation of products. It's a fund called Marcato in San Francisco where Mick McGuire was Bill Ackman's, one of his right-hand men. There's 2 guys who have come out of Carl Icahn's shop. So I think the asset class is building, but it's a small group, and it's very specific to the performance of the people involved. Proxy access. I would really like proxy access done right. We wrote to the SEC supporting I think we were looking for 3% ownership for 3 years or something like that. The axis, the things people were toggling with was how much of the shares do you have to own and for how long. I think if you set it reasonably high so that you're not having people with agendas that are non-economic, creating, I think, a pretty chaotic situation and who aren't there for very long. I think it's a great idea. This is a little self-interested because it would play right to our strategy because usually in year 2 or 3 is when we're going on the board anyway, and to be able to go and say, okay, take it or leave it because you can have us or we'll just do it ourselves would be pretty empowering for us. But I also do believe that you don't want a kind of Gray Davis recall situation where you've got, child actors and porn stars and all kind of like running for the board. I don't think so. So that's my thoughts on that.
proxy access, just again to remind you, refers to the right of shareholders to nominate directors directly onto the corporate ballot. Most all proxy contests require the activist to generate their own ballot and their own slate and produce their own materials and mail those out to shareholders directly, which costs millions of dollars. if you can nominate somebody to just serve on the ballot that the company is sending out, it's a very different economic proposition. It'd be like, $500 to like submit your candidate statement, and then the company mails the same materials they're mailing anyway, but it has your guy on it, or gal. Okay, I think that looks like we're over time. So thank you all very much. Really enjoyed it. Thank you.